Can you explain to me kind of overview level of like what this insurance investing is and how it works?
Yeah, and I probably shouldn't have used the term investing. That's more of a personal term. I wouldn't call it broad brush investing in insurance. I mean, some can. There might be a compliance reason why you shouldn't say investing in insurance, because some are like, whoa, that's not really an investment. It really depends on how you treat it, right? Yeah. So there's all kinds of different types of insurance out there. There's annuities, there's term, there's variable, IULs, whole life, et cetera. So I try to, me personally, I consume, instead of investing, I consume two different products, term and whole. So I know Dave Ramsey's not a big fan of whole. I am convinced after listening to the experts on the insurance side and listening to his argument on his side that he is dead wrong. I think there's even a paper trail that he's been slapped on the wrist a few times for some comments that he's made, allegedly, right? And that's the code word nowadays when you just say allegedly and that's your get out of jail free card. I just don't think he understands it. But he heavily promotes term. And from what I also understand, it's turned into a Dave Ramsey bash scenario. But anyways, term has its benefits and whole has its benefits. I've used term for specific scenarios. Like when I didn't know any better, I bought term almost 15 years ago. Newlywed and wife pregnant shortly after marriage. And I was like, okay, I want to do the adult thing and buy insurance. In case something happens to me, they're protected. Something has to happen to me within that 20 years because I bought 20-year term. So that was one scenario. Another scenario is I was a guarantor for a bank warehouse line for a bank venture. And so they wanted to have some protection that, hey, while you're a partner in this venture, if you were to die, we need some protection. And so I bought a term policy so that, I'm not around to pay back the warehouse line. If that business were to fold for whatever reason and I pass away or get hit by a bus, then that term gets pushed over to them. It doesn't even go to my spouse. It was written specifically to take care of the bank warehouse line. So there's a lot of different ways. Key person insurance. You got partners in a business and a partner passes away. Well, you may not want to be in business with the partner's wife, right? So that could kick in to, one, deploy capital into the business to pay for the replacement of that partner. Let's say that partner was the CFO and now you've got to go spend money to go find another CFO and a salary. It could kick in for that. It could also be used to buy out partnerships as well. Whole is something I'm a bigger fan of. And let me show you why. All right, so term, because some of the people out there are like, well, whole has a cost to it, right? Because I have what's called cash value building up in my whole life policy. And what it allows me to do, and you all have seen the phrase, become your own bank. So this is what whole life has done for me, is become the bank, right? Now, there are 4 parties to every lending situation. You have the bank owner, you have the banker, you have the depositor, and you have the borrower. Okay? Now, ignore this for a minute. Let's just focus on this. This is a lending situation. Bank owner, banker, depositor, borrower. Which of those 4 is most important? Some people would say bank owner, because, hey, if you don't have a bank owner, you don't have a banker.
But the borrower probably. Because there's no borrower, there's no depositor. The depositor, there's no banker, no banker,
Well,
there's no bank owner.
If you don't have a depositor, you can't have a borrower.
Okay.
So they use fractional reserve lending. So if you don't have a depositor, you can't have money going out to lend. It's called arbitrage. That's how banks make money. So what comes first, the chicken or the egg? Okay, well, the banker, you got to have somebody writing these loans and taking these deposits. The bank owner's not going to do it, right? It's a trick question. They're all equally important. You have to have all four. When I become the bank, guess which one of these four I become? Another trick question.
All of them.
All of them. Good job. I become all of them because I can also set the terms in which I lend to myself. Now, if I were to lend money to myself, do I want to think like a borrower or do I want to think like a bank owner? Because they think two entirely different ways, right? What does the borrower think when he borrows money? Cheap, low rate, right? What does the banker think when he lends money? Higher rate, higher returns. Okay, well, which one, if I own the bank, what mindset should I adopt? The bank owner.
Yep.
So if I am the bank, I want to adopt the mindset of the bank owner, and if I lend to myself, I am also the depositor because I'm the one that's purchasing these whole life policies and adding cash value to it, right? So I'm the depositor. I can do what's called cash loans or loans against the cash value of my policy. And so I'm also the borrower. I'm also the banker because I also set the terms of this. I can determine when I pay it back, what payment arrangements I make, what interest rates I pay. I dictate all of that, if ever, right? So I get to become all four parties of this transaction when I become the bank. Now, here's the other thing that some of the advocates say is like, oh, well, this has an expense to it. Okay, this has an expense to it, but there are two benefits here of whole life. One is death. We all know insurance. Does it benefit, Derek, if you were to die, does it benefit you? No, but it does, intrinsically it does because you've got, wife, kids, stuff like that. So you take care of them. You feel good about that. And that's what helps you sleep better at night. So one can say, yeah, there is a benefit to me while I'm living or when I die because I know that they're taken care of. But, to you and you in the moment after death, there is no benefit to you. It's only a benefit to your spouse and kids, right? So there is a benefit of death. And that is also the case here. Is death. But here's another benefit that people ignore is there's a living benefit. I am consistently executing inside of my whole life policies because they have cash value and I can borrow against those. I can inject capital into my business. I can take advantage of cash flowing opportunities because this is a vessel to store cash. I don't look at this as an investment in and of itself. So some people talk about whole life insurance or IBC as an investment. I would argue, right now interest is really good. There are some policies that are paying out north of 6% on some policies. So is that an investment? Yeah, and I could see where their argument comes from because in this one, it's a guaranteed fixed rate of return, right? So let's say it's 6%. That compounds and you have what's called uninterrupted compounding interest. I would rather have 6%, which is not gangster, 6% that's uninterrupted than a mythical mutual fund that sometimes gets 12%, but sometimes gets 0, right? That's what's called interrupted compounding interest. You could achieve more on a 6% uninterrupted compounding interest than you would on those that go up and down, up and down, up and down, right? Like your 401k, your IRAs, et cetera. But there's a living benefit, so I don't have to just worry about, okay, if I'm dead, are they taken care of? I can actually use these funds to live off of while I'm living. Invest in companies, invest in real estate, whatever. It's called infinite for a reason because there's an infinite way of utilizing this. My wife had a business or has a business. Actually, her business had debt. Okay, instead of going to a bank to consolidate that debt to try to get a lower interest rate, we were the bank. So we actually lent money from the trust, from the policy to her business at a lower rate than it was going to because she had 0% business lines of credit that were about to change to go to 18 to 24%. What rate do you think we charged her business? 0? That's thinking like a consumer. We're the bank. We charge 14%, right? Now, was it free to borrow those funds? No, the insurance company has to make money too. At the time, it was 4%. But we turned 4% into 14%. What's the rate of return? Some people would say 10%. That is wrong. That is the margin, right? Now, if I were to flip this and say I took $4 and turned it into $14, now what is my rate of return? It's easier for us to see. It is a 250% rate of return. Oh, by the way, there's all kinds of tax benefits associated with this. So there was multiple benefits to her business. One, we increased the cash flow of the business because the interest rates went down from 18 to 24% to 14%, right? So the cash flow of her business went up. It's still a loan that her business has to pay back. It was a note agreement between the trust and her business. Now, isn't debt tax deductible? Absolutely. So there was still a tax deduction advantage for her business. But oh, by the way, instead of getting a 6%, we turned those small funds into a 250% rate of return. So that's what you get to do inside a whole. Term doesn't build cash value, and I can't borrow against it in most situations. So these are the two products I tend to stick with. This one I do, quote unquote, investing, but it's what I like to do to not only protect my family, but also utilize it while I'm still alive. And if this is something you'd like to learn more about, I promise, I'm not the one teaching this. I actually have somebody that's been doing this for over 2 decades that can really put this in layman's terms far more and far better than I can. Just go to replaceyouruniversity.com. We've got a carousel there. It will be Replace Your Retirement. So go to Replace Your Retirement, set up a consultation, consume the free information to get a foundation if you want to. Schedule your free call consultation with Jim, Christy, Adam, whoever on the team, and they'll talk to you about all the benefits of whole versus term or both. Like I said, I still consume both. I forgot the biggest benefit of life insurance is there are 4 tax codes that eliminate it from taxation. So it is actually tax-free versus some of these other programs. Insurance has 4 tax codes that eliminate it from taxation. 401ks, IRAs, those are tax deferred. So right now, this is the top tax bracket, 37%, right? That's the top tax bracket. If you're over, I don't know, 400,000 or 500,000, I don't know what it is, but 37%. Do you think with $36 trillion, the tax rates are going up or down?
Up.
Okay. So if you know this is going up, what you're doing inside of a 401k, IRAs, things like that, government sponsored programs, the key word, government, anytime they're involved in something, it's gonna suck. So what you're doing is you're saying, okay, I'm not gonna pay taxes on the dollars now. So it's tax deferred. I'm going to take a portion of my pre-tax dollars on my pay stub and it's going into my 401k or IRA. Now I'm not completely poo-pooing this because let's say the company matches up to 4%. Well, how much should you put into there? 4%, because you get a 100% rate of return. So 100% up to the match, you should do a 401k because your company is giving you free money. But this is tax deferred. So instead of paying taxes on the dollars now at this, we are deferring it into retirement when we need it the most to potentially, and I'm just throwing a number out here, let's just say it was 45%. Why would we wait to pay taxes on the dollars later at a higher rate when we could pay taxes on it now? That's what whole life does. So with whole life, this is after tax dollars. And then once it's in there, no taxes. Ever. Your death benefit is tax-free. You can borrow against the cash value. When you borrow funds, that's tax-free. So it's like, think of it like this. You got a home, it's got equity, you get a home equity line of credit. You pull cash out to do whatever you want with. Do you have to pay taxes on that like it was income? No, it's actually a tax deduction because it's a loan. It's real estate interest. Well, let me back up. Depends on what you put in. If you did it in the home improvements, improving the home, etc., then it's a tax deduction. If you use it to go buy a Lamborghini or vacation, it is not a tax deduction. But that's what I would rather do. I'd rather pay taxes of this and never pay taxes on it again when I need it the most.